good evening, wherever you are in the world. I've been on a trading journey for the past roughly 6 months or so. And this year I'm committing to taking my trading plans a lot more seriously, taking my education regarding trading a lot more seriously. For the sake of myself and just kind of documenting my progress and ability to stay on track with my plan, I'm pretty much recording all of my trades this year, and I'm also going to be, reading the books that I'm reading on video, and I'll be sharing those videos on my YouTube channel. If you want to watch along, feel free. I'm gonna be reading today A Beginner's Guide to Day Trading Online, second edition by Tony Turner. This is what the book looks like. So I have actually already started this book. I'm probably a little bit more than halfway through on this book. And I've just really kind of gotten to the parts that are, I think, really, really helpful and beneficial, especially for where I'm at this stage of my trading. So anyway, so I'm going to be sharing my book reading. The intention would be daily for that to happen. And so if you're a beginning trader, and you're into the crypto market and you want to learn more, or the stock market, this book is primarily talking about the stock market, but if you trade it all, then you know that the similarities between how you would set a trade up and the indicators that you would use, and so on and so forth, those things directly correlate between the stock market and crypto. Of course, there's definitely differences between the crypto market and the stock market. I don't do the stock market at all, but again, the correlations are so strong that this book still heavily applies, and I've learned a lot. Anyway, so I'm going to start reading this. So if you want to join in, get comfortable, get a blankie, get a sweater. I'm gonna get comfortable, and let's read. Yeah, I'm literally your Audible, so enjoy. Center point, the power of intuition. It is only with the heart that one can see rightly. What is essential is inevitable. We're gonna completely start this over. I just fucked up the whole fucking, all right. Center point, the power of intuition. It is only with the heart that one can see rightly. What is essential is invisible to the eye. Saint Exupery. Interesting name. I'm also day trading, so I may be messing with my trades a little bit. How do we define intuition? Our elusive sixth sense, ? Webster says it's the power or facility of attaining to direct knowledge or cognition without evident rational thought and interference, quick and ready insight. Western civilization teaches and even worships rational, logical thought processes. To depend on a knowingness that exists beyond what we can see, smell, touch, hear, and feel is considered quackery. What a shame. In our strict adherence to judging all situations using only logic and reason, we've ignored a wonderful and intelligent gift inherent in each one of us. Science now confirms that the human mind operates on two levels: the conscious or rational mind and the subconscious or intuitive mind. The conscious mind acts like a computer. It processes our experiential data, judges using previous input, and calculates conclusions. I promise I can kind of fucking sort of read. We're gonna get through this. Our intuitive mind, however, has the ability to access a vast storehouse of wisdom and insight beyond our own personal boundaries. It analyzes the information and presents it to us as guidance exactly when we need it. We refer to the insight as intuition, or a gut feeling. When we respect and nourish our intuitive sense and allow it to become a guiding force in our lives, our sense of self-trust expands. Feelings of security and empowerment strengthen all areas of our lives. How do you go about accessing and following your intuition? One way is acknowledging its presence. Another way is by asking questions of this wisest part of you, such as, what do I need to know now? What shall I do in this situation? A feeling may emerge immediately that you can identify and act upon. If not, trust that answer to your question will soon appear in an idea, conversation, book, movie, or event. The more you practice, the easier and clearer these communications will be. Our intuitive power is always available to us. It knows how to overcome challenges and achieve goals. We need only ask and then trust. All right, this is chapter 9. It is titled Plan Your Trade and Trade Your Plan, which is interesting and very coincidental because literally that's what I'm practicing, is sticking to my trading plan. And if you are a beginning trader and you are starting to use trading plans, then you probably have already experienced how difficult it can be to actually stick to your trading plan. If you don't stick to your trading plan, you can blow your account like in a day. I don't care how much money you have in your account. You can blow just about any account in a day without sticking to your trading plan. So I think this is a great chapter for us to start out on. I'm excited. All right, here we go. Plan your trade and trade your plan. So you're driving to Yuma, Arizona from Boston, Massachusetts, and you've never been to Yuma before. You wouldn't start driving along the highway without consulting a map, would you? If your appendix needs to be removed, your surgeon wouldn't, we hope, take scalpel in hand unless he first studied an x-ray, would he? The builder who constructed your home didn't throw pipes and bricks into a pile. He followed the blueprints, right? Professional athletes don't run onto the ball field without an established game plan. The legendary UCLA coach John Wooden told his players, if you fail to plan, you plan to fail. Just as these professionals planned their actions before they executed them, as a successful trader, I'm sure you wouldn't consider placing thousands of dollars on the line without first creating a precise trading plan. Believe it or not, it happens. It definitely happens. But don't do that. All right, you plan your trade and you trade your plan. Once you've opened a position, the deftness with which you manage the trade determines its success. First, we look at a basic spreadsheet you fill in the minute you buy or sell short the stock, or crypto in this case. We'll discuss top-down versus bottom-up trading tactics. We'll go on to the simple but vital decision support concept called risk-reward analysis. Finally, you'll learn the criteria for entering and exiting long trades in all time frames. How to design your trading log. Buying a stock is a walk in the park, or crypto, same thing. Consistently exiting trades with a profit, however, involves planning, skill, and discipline. In chapter 4, we talked about trading with confidence and self-trust. Nothing promotes terrific feeling like a well thought out trading plan. A simple written plan for each trade is one of the best things you can do for yourself and your account. They stop you from fudging on the stop losses you urge to take profits realistically. Like, if I'm not gonna fucking be able to read, we're not gonna be able to fucking do it. Rewind. A simple written plan for each trade is one of the best things you can do for yourself and your account. They stop you from fudging on the stop losses and urge you to take profits realistically. I keep an informal worksheet when the trade is in progress and complete a trading log when I exit the position. Both are very simple. If you like, combine the two. I don't like too many numbers and columns staring me in the face when the market goes bonkers and I'm searching for stop loss points. I trade with a yellow legal pad at my elbow as my worksheet. Did you know the color yellow promotes better thinking? I did not. That's why legal pads are yellow. My trading log is an Excel spreadsheet. When I spot a high probability setup, I calculate the risk-reward ratios on my legal pad using support and resistance on weekly, daily, and or intraday time frames. Depending on the type of trade, core, swing, or day, if the setup behaves well and I enter the trade along with entry price and number of shares, I jot down my initial stop loss price in the stop column. Then I enter it as a stop loss order with my broker. On the rare occasion that I don't enter an automatic stop loss order, I circle the stop price on my worksheet, my personal head game to assure I stick to it. Hot tip. Studies verify that people who mentally store their goals accomplish little. Those who write down their goals accomplish more. The same result occurs when instead of mentally storing your sell stop, you at least write it down. I realized early in my trading career that when my stock started to drop, I easily justified lowering my mental stop to the next support level. When I wrote that stop down though, seeing that number on paper supported the discipline to execute it. Of course, your best action is to enter a stop with your broker immediately after entering a trade. Now that I've taken the trade, even if it's an intraday trade, I record resistance levels on my worksheet displayed on daily and possibly even weekly charts. If a stock is overbought, for example, on a daily and weekly chart, it can affect how its prices reacts on a daily chart. While buying euphoria and a positive market environment can drive the stock higher in the morning session, profit taking many times takes over in the afternoons, as traders take their profits and head for the door. Of course, when my stock nears a potential resistance area that also represents my profit target, I watch it closely. I tighten my stop. I may take partial or all profits. If the market's strong though, and my stock or crypto shoots through the resistance to a new high, I'll keep the position. Depending on market conditions, I may add to it. Whatever the case, with the resistance number right in front of me, if I'm busy with another trade, I can glance at it and remain aware of the stock or crypto's activity. I allow 3 spaces on my log to record multiple trade exits. Say you buy 800 shares of Oracle Corp at $14.29. Then you offer it out in 2 300 share lots and at a final 200 share lot, taking profits at $14.70, $15.20, and $15.40. It's a good tactic, offers safe profits, and if you design your spreadsheet with multiple exit rows, you have enough room to record each sale separately and net price or proceeds. Of course, if you want to combine your worksheet and trading log, incorporate the column headings in your worksheet into your log. I find that by designating the intended time frame, core, swing, or intraday into my sheet, it keeps me honest. I avoid the urge to ignore mental stops and allow day trades to turn into investments. If you want to see the example that they've given in the book. So that's just the example of whatever it is that she did. All right, hot tip. The longer the time frame, the stronger the signal. Buy signals on weekly charts, for example, are stronger than sell signals on the same stock on daily charts. Buy or sell signals on daily charts hold more weight than signals on intraday charts. In my book, Short-Term Trading in the New York Stock Market, you'll find a trade sheet with a conscience. Okay. Besides the basic headings of entry and exit dates, symbol, share size, and profit and loss columns, the sheet lists types of trades, whether it's a position, swing, or intraday, initial stop, profit target, risk-reward ratio, adjusted or trailing stop, and adjusted profit targets. Detailed, yes, but by completing the columns, you learn a lot about risk management techniques and your trading strengths and challenges. Viewpoint, top-down versus bottom-up approach. Ask any trader why he or she is a top-down or a bottom-up trader, and that person will earnestly try to convince you why he or she is right. Actually, variables in the market climate, along with industry group categories, contribute to benefits to both approaches. Top-down traders. Top-down traders assess the entire scene before they leap. They're like airline pilots who lift their planes off the ground only when all conditions, including weather and equipment, operate perfectly. Before placing a trade, a top-down trader, 1, considers overall market trend, 2, checks internal market indicators, 3, inspects a chart of the target stock's industry group, 4, studies the stock's weekly, daily, and intraday charts. If signals align, the trader awaits for a precise entry point and enters the trade. If the signals are out of sync or negative, the trader waits for a better opportunity. Bottom-up traders, this doesn't sound like it's going to be good. A bottom-up trader looks at the stock's chart at different time frames and might glance at fundamental information, but ignores market conditions and industry group action. Start out as a top-down trader. Try starting as a top-down trader. You want every possible odd in your favor before you risk your money. Fuck yeah. 3 out of 5 stocks will follow the broader markets higher, especially in a bull market. 4 out of 5 follow the broad indices down in a bear market. The goal in putting the Dow, NASDAQ, industry indices, and market internals like the tick, trend, and E-mini S&P futures on your screen was to show you how even during the rosiest moments, a strong indicator like the S&P futures can implode suddenly and drag the majority of stocks with it. Several trading books show a chart with a candlestick pointing through resistance. These books have an arrow pointing to the breakout candlestick and cheerfully explain by the breakout. This book gives similar suggestions, but when I write buy the breakout or sell the breakdown, from this time forward, I'll assume you'll enter that trade from a top-down perspective. Couple the top-down trading criteria with common sense. Why enter a position or swing trade or any trade at all on a day when mother market is in a rotten mood and odds are good you'll get stopped out? On the other hand, when you already have open core or swing trades, if the E-mini S&P futures undergo a few intraday hiccups, you can ignore them as long as your stop loss order is in place. Here's my top-down checklist. It appears to all trading time frames except scalping plays. Scalps are so brief, they need not fill all the criteria except the market upward or downtrend. Is the market in an uptrend or downtrend? Remember, the trend is your friend. Trading with the overall market trend increases your odds for success. Is the FOMC, Federal Open Market Committee, due to meet in the next day or two with possible interest rate tightening? The market dislikes rising, tightening of interest rates. Simply put, it means corporations pay more for their business loans, so their earnings aren't as high. If so, wait until after the results of the meeting to place longer-term trades. Is your target company coming out with earnings in the next few days? Please don't risk holding a volatile stock, especially overnight when its earnings are due to be issued. Companies announce earnings before and after the closing bell. Very few announce during the course of the trading day. If the earnings exceed estimates, the stock may shoot up. But if earnings are negative, it could gap down the next morning. Now, consider the guidance statements issued with earnings. A company might announce good earnings along with guidance that states the next quarter's sales are expected to soften. That can send a stock lower. Also, when giants like Dell or Microsoft announce negative earnings, you can equate that to maybe Bitcoin or Ethereum and crypto. They take at least their own industry and sometimes the entire NASDAQ down with them. Very true for Bitcoin. Very true. It leads crypto, obviously. Otherwise, known as a tech wreck, stay on top of the dates when giants' earnings announcements are publicized. If earnings announcements are due and you'd prefer not to exit core positions, check your holdings. Composite ratings in Investors Business Daily. Ratings more than 60 or 70 add a comforting, if not foolproof, safety net to the trade. If you subscribe to a news service that issues pre-earnings estimates by such organizations as Reuters or Zacks, check to see if your holdings estimates look favorable. They may not be right on the money, but you'll get an idea whether the pros think earnings will be positive or negative. If your stock is on the New York Stock Exchange, check the Dow and S&P 500 daily trends. Do the same with the NASDAQ composite if your target stock resides there. Market averages influence stock behavior and direction. For me, what I use kind of with crypto, which I think would be one equivalency to what she's talking about, is I use what the fuck is it called? It's called total. It's an index, right? And it's a total crypto index. So what it does is it literally gives you a chart to look at how much money is either being put into crypto or is being pulled out. And when you look at that index, you'll see that the like Ethereum, Bitcoin, their chart will look almost pretty much identical in most cases that I have seen to the index. So when you look at that index, the way that that's moving, like it's going to show you how much money is pouring in, how much is being taken out. And I can almost guarantee you, unless you have some kind of really unusual, very significant catalyst, Bitcoin is going to be moving the same way that index is moving. Ethereum is going to be moving the same way. So, I mean, you pretty much know if you see a bunch of money getting pulled out of the market, Bitcoin's probably going down, and so is Ethereum, and whatever else is like the top, 8 cryptos could even probably extend down to like the top 20. So keep that in mind, or test it out for yourself and see how you like it. You already know to check the NYSE or NASDAQ tick trend and E-mini S&P futures to make sure all systems are a go. Tick positive, trend under 1.0, futures in an uptrend. That's very specific to stock. Hot tip, if you are a novice trader, beginning trader, start by executing successful position and swing trades. Once you understand how the market works and how quickly it moves, You may want to try your skills at day trading, keeping in mind it's dangerous. If the procedure sounds tedious, don't worry. With practice, you'll be able to evaluate this information in a matter of seconds, and that's true. It'll come to you pretty quickly. Market sectors. There are 12 basic economic sectors in the U.S. stock market. All industry groups such as banks, biotechs, semiconductors, gold and silver, auto and truck manufacturing, airlines, and many more fall under these headings. 1. Financials. 2. Technology. 3. Healthcare. 4. Consumer cyclicals. 5. Consumer non-cyclicals. 6. Industrials. 7. Energy. 8. Telecommunications. 9. Basic materials. 10. Utilities. 11. Conglomerates. 12. Transportation. Plan your trade with risk-reward analysis. Risk-reward analysis represents an essential role in pre-trading planning. Please enter a trade only if you've conducted your risk-reward analysis. Here's a basic explanation. Dicey Delivery presents a good setup, and you intend to buy shares of Dicey if it reaches your entry price of $20 per share. You've designated the trade as a swing trade, so your established risk-reward objective should be 1 to 3. That means 1 part risk, 3 parts reward. Next, you decide if Dicey goes against you and falls through nearby support at $19, you'll sell. Therefore, $19 represents your initial protective stop and is 1 point away from your entry price. Finally, you determine your profit target. You look for resistance, which in this case is the previous day high on Dicey's daily chart. Prior resistance is $23. Since your profit goal needs to be at least 3 points higher than your entry, this price target meets your criteria and adheres to your risk-reward objective. To summarize. So entry price, this is the breakdown, entry price $20, your initial stop loss $19, and your initial profit target is $23. You can see how your risk is 1 point away from your entry price, and your potential profit is 3 points away from your entry price, yielding a risk-reward ratio of 1 to 3. Usually, I calculate these numbers by establishing my stop loss point first. For example, maybe the best entry break above resistance is at $30. And my initial, because you'll raise it as your stock moves higher, is 29.25, a spread of 75 cents. To achieve a 1 to 3 risk ratio, I know my profit target has to be at least $2.25. Which is 3 times 75 cents, above $30 or $32.25. That means the prior high or potential resistance on my target stock's daily chart for a swing trade can be no lower than $32.25. If it is, say $31, then the potential reward is not large enough to justify the risk. Can I squeeze the stop loss price to make it smaller and justify the reward? Sure. However, if you place your stop too close to your entries, you risk getting stopped out a lot. A string of small losses equals 1 big loss. Facts. The longer the time frame of your trade, the larger the reward portion of your ratio should be. Why? Because the longer your capital is at risk, the larger potential reward you should expect. That's why the recommended risk to reward ratio for swing trades is 1 to 3, with 1 to 2 being the minimum. With day trades, the risk reward ratio is 1 to 2. 1 to 2 is acceptable, but whenever you can find a trade that offers a greater rewards ratio, it's preferable. Why don't we enter trades with a 1 to 1 ratio? With slippage and commissions, many times you're starting with a loss when you first enter a trade. The price has to go your way for a percentage of a point just to break even. Over time, a 1 to 1 ratio delivers a low probability of consistent success. Certainly, experienced traders take trades with even amounts of risk and reward. Novice traders, however, would do well to keep the odds in their corners until experience sharpens discipline to a razor-like edge. Calculate your risk-reward ratio before you enter each trade. Calculate your risk-reward ratio before you enter each trade. If it doesn't work out to at least 1 part risk and 2 parts reward, and 1 to 3 is better, consider avoiding the trade. Money-making chart patterns for position trades. Now let's look at chart patterns and criteria for placing a trade. We'll start with core or position trades. These are interchangeable terms. In Chapter 10, we'll move into swing and intraday trades. Study the following patterns carefully. They apply to all time frames. When you buy a stock for a position trade or short-term investment, plan to hold it for a week to several weeks or more. These stocks represent your core holdings. As I mentioned before, they make a nice pillow during times when you feel as though your trades are using you for a punching bag. As mentioned in earlier chapters, a position or core trade racks up the high weeks. It racks up the highest profits when you locate a stock that's formed a basing pattern for at least 2 weeks. Longer is better. Why? Price has a better chance of rising when resistance is at a distance. When it breaks out of the base, the sellers are momentarily exhausted. The goal of a core or position trade is to stay in the trade for the breakout and duration of the uptrend on a daily chart. On core trades, expect multiple points. For these longer term trades, again, the closer the leading or initial breakout you enter, the more upside you have ahead of you. In a bull market, high quality stocks entered at the right time can double in value. Facts. The basics: continuation and reversal patterns. I like reversals quite a bit. All right, got cold. I had to put a sweater on. Let's continue. All right, the basics: continuation and reversal patterns. As price cycles move forward in time, these moves create recognizable patterns on charts. As you saw in earlier chapters, the patterns are fueled by human emotions. You could say that you're looking at human behavior on a chart. Because we humans repeat our actions over and over again, they draw similar patterns on the chart and hold predictive value to traders. Technically speaking, these patterns are divided into two basic groups: continuation patterns and trend reversal patterns. A series of horizontal moves create continuation patterns. When uptrends or downtrends become exhausted and reverse, they often form similar, recognizable patterns in the process, known as price reversal patterns. Continuation patterns cause pauses or consolidations. Continuation patterns cause pauses or consolidations. And the stock's prevailing trend, you could say that the stock is resting or taking a break, as swimmers do between laps. After the consolidation, the stock breaks out and the prior trend resumes usually. I know we've already covered breakout and breakdown patterns, but bear with me. We're going to move in for a closer look. Remember to differentiate between horizontal moves so you recognize the difference between bona fide consolidations and whippy, choppy congestion patterns. Stocks in congestion patterns have no clue where they're going. Also, I've talked about stocks moving sideways, trading in a range, moving back and forth in 2 to 3 day or more increments, and moving between a high and low price area. Trading in a range is not consolidation. If none of this sounds familiar to you, go review this: consolidating patterns and congested patterns. As you recall, consolidation means a stock is moving sideways in a tight, orderly fashion. The following interactive demonstration will explain. Please get up now and go sit on your bed. And she goes on to say, yes, you read it correctly. Please go into your bedroom and sit on your bed. Fuck it, let's do it. All right. You're coming with me. Here's bed. We're in said bed. Okay, I'm in the fucking bed. What's up? Where the fuck was I? God damn it. Pause. All right, she says, are you sitting? Good. Notice how your weight compresses the bed springs. So now she's calling us fat while educating us, all right? When a stock consolidates, trading in a string of narrow range days, its pressure from buyers or support backtrack. When a stock consolidates, trading in a string of narrow range days, it has pressure from buyers or support pushing it up from below, just as your box spring supports your mattress. The stock also has pressure from sellers or resistance who push the price down from above as the weight of your body applies pressure to the mattress springs. Now stand up. When you lift your weight and release the tension by standing, your mattress springs spring right up. When you lift your weight and release the tension by standing, your mattress springs spring back up, right? I mean, yeah, seems like it. I mean, I don't know that we really needed to get in the bed to really understand that, Tony, but all right, we did it. And here we are back to our comfortable nook here. Back in my blankie. Hold on. Let me get my shit together real quick. Get comfortable, this motherfucker. Okay. Where were we? All right, yeah. Hot tip. Head fakes are common on daily charts. For example, a stock is moving in an uptrend, then it rests in a pennant or flag. Look that up too. Look that up for sure. Just when it gives, maybe even pause this and look it up, seriously. Just when it gives all appearances of moving higher, it laughs and dives down a point or so. After the rush for the door is done, it climbs higher and goes on to new highs. Moral, don't load up with more than an initial lot until you have confirmation of a continuation breakout. Facts. The tension builds in a consolidating stock until the sheer volume of either bulls or bears, demand or supply, overpowers the other. At that point, it releases or even explodes to the upside. You could say that the stock's price springs into a breakout and a downtrend. The stock breaks down. If you refuse to stand up, eventually the bed sags. As we stated, after a stock consolidates, it usually resumes its prevailing trend. Common and trader-friendly continuation patterns are called lines, triangles, flags, and pennants. A continuation pattern acts as the pause that refreshes. It allows the trend stock to rest by moving sideways or pulling back. Then the stock continues moving in its current trend. The next pattern, depending on the book you're reading, you'll hear it called a triangle or wedge. You can call it a turn up if you want to, as long as you recognize when you see it. And she goes on to show a picture of consolidation and breakout and consolidation and breakdown. And while you can probably pretty much imagine what it looks like, I'm just gonna go ahead and show you so that you know. So it's that one right there, not that one, that one. So you'll see how there's consolidation with it moving to the side, and then you have a breakout up at that top one, and then the bottom, it's consolidating, meaning moving sideways. Those are representative of candles, those lines, and then it breaks down. And so what you can see is basically the pattern that it was taking on beforehand, before the consolidation, it basically just continues it. Figure 9-4 is showing a triangle or wedge. All right, so let's look at that. There you have a wedge pattern, figure 9-4. All right. Next, it consists of a wide range bar followed by a tighter and tighter day pattern. Stay on the lookout for this pattern, and when you see it forming, monitor it for a breakout. It produces dandy trades. A pennant is a small symmetrical triangle, a bit more horizontal in shape, figure 9-5, and its conclusion, the prevailing trend usually resumes. This is a terrific long-term pattern, and it also forms nicely on intraday charts during the lunchtime period. If it breaks out at about 2:30 p.m. with a bullish market environment, you buy the breakout. A flag develops when the price moves sideways in a parallelogram or rectangular shape. Sometimes prices slope against the prevailing trend. Think pullback in an uptrend or rally in a downtrend. And the figure is at the very bottom of the page here. Okay, cool. So I don't want to like make these videos like crazy long. So like if anyone's actually following along, I want you to actually like, you know, watch this and take some notes and maybe go research this stuff and then like come back tomorrow and then we'll do it again so that you're not like information overload. Because I think when I when I edit this, I think this is gonna probably come out to close to like 30 minutes. So it's like almost half the chapter. So come back tomorrow and then we'll do some more reading and we'll read the rest of this and we'll go over some patterns, but definitely the ones that you heard of today and any other ones that you happen to stumble across while you're looking these up, just research them, read about them, look at the pictures. If you actually go to like just google.com and you look up stock and crypto chart patterns, you'll find a whole host of information. Just make sure you're finding it from a reputable source. I have gone online before and I've seen people calling certain patterns other patterns that they actually are not. So just make sure it's a reputable source. Yeah, but go check that out and then come back tomorrow and we'll do some more reading and we'll learn about some more patterns in the market. All right, cool. Bye, guys.
Hey, hey, hey. She say she still love me like it's day one. I tell her, baby, you saucy, you my A1. Baby pussy be spraying like a play gun. I'm an animal, I be gawking at it like a raven.